What happens when a major tax overhaul meets a strained system? For many Americans, this tax season was supposed to be simple. File early, wait a few weeks, get a bigger refund. Instead, something else is happening. Refunds are arriving unevenly, timelines are shifting, and few people are certain why. The 2026 tax filing season officially opened on January 26th, covering income earned in 2025. This year's filing period looks different because it follows one of the most significant federal tax updates in nearly a decade. The changes stem from legislation passed in mid-2025, often referred to as the One Big Beautiful Bill. Lawmakers used it to extend and lock in many provisions first introduced under the 2017 Tax Cuts and Jobs Act, while adding several new deductions and updated credits. Before this year, many of those individual tax cuts were scheduled to expire. Instead, they were made permanent. That decision reshaped how much income is taxed, how deductions are applied, and how refunds are calculated. One of the most noticeable changes is the higher standard deduction. It rose again for 2025 and was adjusted for inflation. At the same time, federal tax brackets were widened, helping prevent bracket creep, a situation where inflation pushes income into higher tax rates without real gains in purchasing power. Then came changes to tax credits. The child tax credit increased to $2,200 per qualifying child and is now indexed to inflation. For many families, that alone translates into a larger refund or a smaller tax bill. Another major shift involves state and local tax deductions. The SALT cap jumped from $10,000 to $40,000 for 2025, restoring a benefit many homeowners lost after 2018. The expanded deduction applies mainly to taxpayers who itemize and phases out for incomes above $500,000. At the same time, new deductions were introduced for certain workers. Taxpayers can now deduct up to $25,000 in tip income and up to $12,500 in overtime pay, or $25,000 for joint filers subject to income limits. Because employers were not yet required to report these amounts separately on tax forms, the IRS allows workers to rely on pay stubs, tip logs, and similar records. Taken together, these changes meant many workers overpaid taxes during 2025. Withholding tables were not fully updated to reflect the new rules, setting the stage for larger refunds in 2026. But then came the complications. The IRS entered this filing season with fewer staff and ongoing system upgrades. While refunds are typically issued within about 3 weeks for simple electronic returns, that timeline is not guaranteed. Returns involving new deductions, credits, or discrepancies are more likely to be flagged for manual review. Federal law also delays refunds tied to certain credits until at least mid-February, even if the return is accepted earlier. For some taxpayers, that has added to the uncertainty. Officials have urged filers to submit returns electronically, use direct deposit, and rely on online tracking tools rather than phone inquiries. Paper returns and amended filings are expected to take significantly longer. Beyond individual refunds, the timing matters economically. Larger refunds can increase household spending early in the year, while delays can create short-term financial strain for some families. Over the next several weeks, refund patterns will become clearer as delayed credits are released and processing continues. Whether this tax season becomes a smooth transition to a new system or a warning about capacity limits is still unfolding. The next few weeks will show whether these changes deliver on their promise or expose deeper strains beneath the surface.